I want to talk about insurance companies. Now, we're all familiar with the concept of insurance. Most of us have health insurance, life insurance, auto insurance, homeowners insurance. But, what are the properties of an insurance company and what is it they're doing exactly? Well, insurance companies assume the risk of their clients in return for a fee, and we call that fee the premium. So your auto insurance premium is due or your health insurance premium is due. And it turns out that most people purchase insurance because they are risk averse. What does that mean? It means they would rather pay a premium and receive a certainty equivalent than accept a gamble. So let me give you an example here. Suppose there's a gamble and the investor has a 50% chance of winning 50,000 and a 50% chance of winning 150,000. So if we took the expected value of this gamble, it would be $100,000. Now if we look at this graphically, what I have here is I have a utility function, and down here I have the amount of wealth. So this is the amount of utility the person receives based on how much wealth they have. And you'll notice that it's upward sloping and that it's concave. What does that mean? The concavity here means that the person is risk averse. Well, what do I mean by that? Well, you can look at this picture here. We know that the expected value here is 100,000. That's what we calculated. And if the person received $100,000 with certainty, they would receive this amount of utility. We could draw over here. I didn't label it. We could call it, U1 or something. But if you take the gamble, you actually get less utility for an expected value of 100,000. Notice this is lower than this one. That's what we mean by being risk averse, that you don't get as much satisfaction from the gamble as you do from something that's certain. So what's a certainty equivalent here? This person might be willing to pay $10,000 and receive $90,000 with certainty. So you'll notice this height here is the utility that the person receives if they take the $100,000, the gamble, to receive 100,000. That is 50% chance of 50,000, 50% chance of 150,000. But here they're willing to accept a guaranteed 90,000 and they get the same utility. That's what we call the certainty equivalent. And essentially that's what people do. Why do people pay for life insurance? Well, on average, a young healthy person, who's 30 years old, is probably going to live a lot more years. But you may buy life insurance because you have a spouse who will need the money should you pass away to pay for the house. You may have children, so you want to provide for them. So you're willing to give up some money, this distance here is sort of the premium, in order to have some certainty. In terms of insurance, there are certain fundamentals of insurance. There are a lot of different types of insurance, but there are 7 basic principles that all insurance companies are subject to. First, there must be a relationship between the insured and the beneficiary. And also, it's the case that the beneficiary must be someone who would suffer if it weren't for the insurance. So if you have a husband and a wife, and the wife passes away, the husband may have financial difficulties if it weren't for life insurance. So it's certainly acceptable for a spouse to have life insurance to protect the surviving spouse. It's also the case that if you own a car and the car was in an accident and totaled, that would be a significant loss to you, so you can insure your car. What you can't do is go around and insure a bunch of other people that you don't know. You can't decide, many world leaders are not very well liked, or at least there's someone who's against them. Somebody might get assassinated. You know what? I'll buy life insurance on all of these different world leaders, and if one of them gets assassinated, I will collect. Well, you can't do that because you have no relationship with that person, and it's also the case that you're not going to suffer any financial loss should that person die. So you can't insure, you can't take out an insurance policy on the prime minister or the president, etc. The insured must provide full and accurate information to the insurance company. This is the way that the insurance company is able to determine the appropriate premium. How do they know how much to charge you for health insurance or life insurance? Well, they need to know whether you're a smoker or not, for example. So if you lie about that, they could void your policy, or in many cases what happens if a person buys life insurance and claims to be a non-smoker and they pass away, and it turns out they were in fact a smoker, what the insurance company will do is they will take the premium that was paid, and if the premium, say the person bought $100,000 worth of coverage, but the premium they paid would have only covered $75,000 for a smoker, then they will just reduce the policy amount. The insured is not to profit as a result of the insurance coverage. So you can't go and insure your $200,000 house for $700,000 so that if it burns down, you actually get back more than the house was worth. Or you can't insure a piece of an artwork for more than it's worth. In fact, that's why people will get appraisals. If you looked at policies, they might limit the amount that they will pay for jewelry. They might limit it to $1,000. If you happen to have a very expensive engagement ring, you can get it appraised and insure it for a higher amount, but you can't just insure for whatever amount you want. If a third party compensates the insured for the loss, the insurance company's obligation is reduced by the amount of the compensation. So, for example, if you happen to get into a car accident, it's the other person's fault. You're in a state that has no fault insurance. If your insurance company is able to recover some of the cost from the other driver's insurance company, then their loss is reduced. Fifth, the insurance company must have a large number of insured so the risk can be spread out among many different policies. This is how life insurance works. Insurance companies know, and they do a lot of statistical analysis that's done by people known as actuaries. They know that a certain number of 45-year-old male non-smokers will pass away. They don't know who those people are, but they know fairly accurately with all the data they have how many will pass away. So if they insure thousands and thousands, tens of thousands, hundreds of thousands, they may know that 2 or 3 will pass away. They don't know which 2 or 3, but it doesn't matter because if they've insured, they've written policies with it on enough people, they will make money from those that don't pass away and will be able to pay the claims for those that do pass away. The loss has to be quantifiable. So they need to be able to figure out, what's the loss here, what's the likelihood of loss. For example, an oil company can't buy a policy on an unexplored oil field because they can't quantify that. Hey, insurance is not gambling. It's not gambling for the insurance company. They want to make money, and they want to be able to work out statistically the probability of a loss occurring. And that's number 7. The insurance company must be able to compute the probability of the loss occurring. If they can't compute that probability, they can't set a fair price or a fair premium so that they make money and are able to cover the claims. And again, if you think about it, what good is buying insurance if the insurance company goes bankrupt? So it's really important that the insurance company knows the probability of loss. In fact, and they will do things to protect themselves. They won't write all of their homeowners policies in exactly the same location because a hurricane or an earthquake could devastate an awful lot of homes in that same area. So they spread the risks by diversification. So those are the basics that every insurance company follows, whether they're health insurance companies, life insurance companies, or property casualty insurance companies.